Hey everybody, it's Chuck Barone. Thursday, September the 21st, 2023. And today the market has indigestion from the Federal Reserve, man. Funny, well, we got a lot to talk about today, guys. But before I get rolling along, let me welcome everybody to the show. As always, thank you guys for your support. You guys keep watching the videos. We're going to keep making them for you guys. We appreciate your support. You guys keep coming back, with your questions and comments, hitting us up in likes, and just taking care of the show. We're going to do our best to take care of you guys. All right, so let's talk about these markets today. We knew we were going to get some data today, but the Fed or the market's really now starting to digest the message from the Fed yesterday. Yesterday it was all okay, dodged a bullet, didn't get a rate increase. But the language and the data that the Fed released after spooked the crap out of the market because they're finally coming to the realization, what I've been telling you guys for a long time on the show. You guys have heard me say, the era of easy money, this free money thing we've been doing in this country for so long, encouraging people to take on unmanageable levels of debt, that era's over. And I'm old now, so I've seen this stuff come and go. And I've seen, easy money eras like this one's been really loose pretty much since 2008, right? And I've seen some real tight money eras, 80s, mortgages. Wow, when I first got into mortgages, people were refinancing down to 8%. So, we're going back now to a more traditional model where debt is not going to continue to be rewarded by making it super easy to get, continually making more debt available, and making that debt super cheap. Those days are gone. And now we're moving into another era when it might turn out to be okay, because debt sucks and everybody that has debt understands that. But now we're going to move into an era where actually saving money is going to be encouraged. There really was no reward for people that saved. Your savings account, it used to be embarrassing looking at you get your 1 penny a quarter, right? The interest rates were 0.1%, basically. Money markets were flattened out pretty much to zero, just like savings were. Well, now I'm getting five and change, and a money market is pretty attractive, with absolutely no risk and complete liquidity. So, maybe this change in era is going to turn out to be a good thing, where Americans can start to get back to more manageable lives with, saving a certain percentage of their money, earning some money on the savings and being rewarded for those savings, being discouraged from taking on unmanageable levels of debt, especially frivolous debt. Mortgage is one thing. Massive amounts of credit card debt that you spent, going out to eat or at stores, completely something else, right? But anyway, markets today reacting to the idea that the easy money era is over, coming to understand that interest rates could go even higher. They really had pretty much written it off. Coming to understand that interest rates are going to stay higher for longer, but pretty much now looks like through next year. But I say, that's still data dependent too. What if inflation rates are still 4% next year at this time? Think we're going to be looking at rate cuts? I don't think so. So we'll see. But anyway, today markets, reality check day, the Dow down 370 points. 34,070 on the Dow. The S&P, the broader market, really tanking down 72 points. 4,330. And the NASDAQ down 245 points. 13,223. So stock markets take a pretty good shellacking today. Bond market, same thing, selling off like crazy, especially 10 years. The 10-year jumping 13 basis points, sitting at 4.48%. The highest number pretty much on all denominations since 2007, before the big kablooey, 4.48%. The 2-year only up 2 basis points, sitting at 5.15%. So now that inversion's really narrowing down, right? And the bond market still looking crazy as hell and volatile as hell too. Not good. The dollar today, still the king, basically flat, sitting at 105.41 on the index. Still solid as you can get. Precious metals, gold and silver. Gold falls today, $10.30, sitting at $1,919.50. Silver actually gains today, up 15 cents, $23.37 for an ounce of silver. So they're holding their own in the face of this amazing dollar and a big sell-off of everything today. Oil today, down 9 cents, breaking back under $90 per barrel, $89.57. So now we have to watch oil and see, is this the end of the run? The spike, is this the end of it, or is this just a breather? You know, kind of catch its breath before the next leg. We'll see. I was reading a lot of analysts now starting to talk about $100 plus per barrel. We'll see who's right there. I hope not, because already at this prices, we're seeing gas prices just explode here in Las Vegas. And Bitcoin today down $421, 26,565. Bitcoin now, it's interesting, seems to be moving more with the market than really in any independent kind of way. You know, when the stock market's up, typically Bitcoin's up with it. When the market's down, Bitcoin down with it. Interesting. We're going to keep an eye on that to see if they really are they linked like that. And if they are, what does that really mean for Bitcoin? Anyway, moving on, let's talk about some stuff today. The big data we were waiting for, jobs today. Jobless claims coming in, 201,000. They were expecting 225,000. They were expecting 220 last month, which beat expectations by 10,000. They thought they were going to get 230. They got 220. This month, this week, they're expecting 225. They get 201. So the jobs are just still kicking the analysts' butt, man. They can't get it right. Their best guesses are way off. This jobs number is going to put a lot of pressure on the Fed now. It's like I was talking about yesterday. They should have just went ahead and raised rates yesterday. Because now, as the data piles up and it comes in and everything that's coming in is working against what the Fed wants to do, hot jobs. Now, you know the Fed believes that this hot jobs market leads to wage increases, and wage increases lead to inflation. Yay, Fed, good thinking. So this is not going to make the Fed happy. They already had a pretty significant majority, I guess 12 of the 19 Fed voting governors, talking about at least one more rate increase this year. You know, they really made a mistake yesterday just not getting ahead of this and raising. If they're admitting, they're telling you they're going to raise again this year. Why wait? Just raise it. Be done with it, right? Anyway, Powell, disappointing me. He talked pretty tough yesterday. But actions speak louder than words, right? So talking tough, that's for your political friends. What was the action? They just sat down and shut up. They didn't raise the rates, left them steady. So now here's the first another piece of bad news right after the following day. Guess what? Hot jobs, higher inflation coming. And we totally wimped out yesterday, but we'll see how they react again now. Everybody wants to pretend that the Fed is this Fed playbook, we're just going to raise rates and now we can stop and we're finished. They want to pretend like this is infallible and this is the way it is, and this is, it's like, the sun rising in the east. Well, here's the news flash, man. It doesn't work that way. The Fed is reacting. They're reacting, right? Now, we've talked about this on the show again many times. The last time we had real inflation, sustained inflation like we're having now, back in the 70s and 80s, it took a decade to get the numbers down. It took a decade, 10 years. Now, right, all the presidents that went through the inflation stuff back then, man, sucked it up, right? We had Johnson started the big inflation with guns and butter. We had Nixon, price controls, tried a whole bunch of things to get it under control. Ford, Carter, big inflation. He took the big blame of it, even though it sucked during his term, obviously, but he wasn't the start of it. He just was the kind of final blow up of it. And then finally Reagan, who inherited a pretty high number, went higher still, but took the right approach, snuffed it out. Paul Volcker. But all of those presidents went through this before they could finally get it right. Now, we learned some stuff. I'm sure the Fed governors learned some stuff, right? But what it took to get that number to back down to target or less was a pretty massive recession, an ugly one, a deep one, maybe not super long lasting, but deep, with 10% unemployment and interest rates at 20%, the overnight rate, Fed rate. Now, this time around, the Fed's just going to boom, 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 raise rates up a little bit, and guess what? It's all over. I got to see it to believe it, man. I just don't believe that everything's going to work out perfectly for them. I just don't buy that. Where does that exist on planet Earth? So we're going to watch this. It's going to be amazing. I made some notes here, right? It said, this time everything is going to go perfectly, and that we're all going to be finished knocking this inflation down in about 18 months, maybe a little longer. Even the Fed, in their notes and their stuff that came out from their meeting, sees interest rates 5% or higher into 2025. So they're seeing rates high all the way through next year. They changed their dot plot, showing now another interest rate increase coming this year, and showing next year they've had 4 rate cuts. 4 rate cuts dot plotted in. Now they're down to 2. We'll see if we get any rate cuts next year. It's going to be, I got my doubts. So you got to be a sucker to believe everything's going to be perfect, especially at a time like this, and all the things we talked about yesterday on the show lining up to work that are going to be working against the Fed. So what do we do about it, guys? What can you and I do to take advantage of this stuff? 2 things really important. Number 1, try not to take on new debt. Debt's expensive. Try not to take on new debt if you can help yourself. Emergencies and things of that nature are different, but be cautious. And the second thing is, what I've always preached, and guys yell at me about it on the comments, but you got to save money, man. You got to live within your means. You got to stash some money, no matter how little it is. Start to learn to save something. Now, once you're saving something, increase those savings. You'll learn how to do it, and once it becomes a habit, now it can turn into an obsession, so don't let that happen. But it's just going to get easier to do and more pleasing as you start to see your savings grow and accumulate, especially now that you can actually earn some money on your money, right? So, guys, we got all kind of crazy stuff going on. More data today, too. Existing home sales, 7-month low, cratering out, no existing homes for sale. Therefore, the median price still going up, even though sales cratering. $407,100 median price across the U.S. Outrageous. So the world's still up its rocker, but we're here normal. Seeing the world for what it really is, or at least trying to. That's it for the day, guys. We appreciate your support as always. We will be back tomorrow to wrap this week up. Tomorrow should be a quiet day in the market, but with all the data that came today and is still to come, we'll have a lot to talk about. We'll kind of try to get a peek of what's happening next week and what we can expect going forward. Anyway, guys, that's it for the day. We appreciate your support as always. Until tomorrow, then, take care. Thanks.